Portions of the following program may be pre-recorded.
The following program is sponsored by Max Out Savings Advisors. The views expressed during the broadcast are solely for entertainment purposes and do not necessarily express the views of KNTH, its management, Max Out Savings Advisors, or its sponsors. Max Out Savings Advisors and members of the Max Out Savings team may or may not hold securities mentioned during the show. Plan for your prosperity, prepare for your retirement, safeguard your savings, and nurture your investments. This is the Max Out Savings Show with Ted Gioka, a presentation of Max Out Savings Advisors. Now, here's your host from Max Out Savings Advisors, Ted Gioka.
Welcome to the Max Out Savings Show. I'm Ted Gioka, and we're talking savings, investments, and your retirement here on the Max Out Savings Show. Our show is all about building up wealth, understanding the world today, and in navigating through retirement and to a happier future, and really understanding where you need to be. Our motto and our philosophy is to save aggressively and invest conservatively. Now, we talk a lot about retirement, but you're not going to get there unless you save aggressively and then conservatively invest the money, and that's why our motto is to save aggressively and then invest it conservatively. And you can do that as you go into retirement too by keeping your costs down low. But this is kind of the key, is you want to build up that wealth ahead of time and protect yourself. We talk about on this show constantly. We're now up to $38 trillion worth of debt. We went through a $1 trillion worth of debt in the last 60 days due to some of the government to the debt limit, and once that came off, the debt jumped up again, and the money just keeps going up. I think the numbers are, if you count to like 1, 2, 3, 4, 5, it takes like 30,000 years or something like that to actually hit $1 trillion. The number is so gigantic that nobody even really understands what it is, and yet here we are spending money like no tomorrow, and $1 trillion here, $1 trillion there. Pretty soon you're talking big bucks, and it just, I mean, actually, I think it was one of our callers a couple shows back or so actually mentioned, a billion here, a billion there. That was it was either Senator Dirksen or I think Bunker Hunt, one of the two. It was a billion here, a billion there, and that was back in the 70s, I believe, early 70s maybe. And now here we are, 50 years later, and we're talking about a number 1,000 times bigger. And just to put that into perspective of just how much this spending has gotten out of control. So you want to continue to save money to protect it. We've talked about this move. One of the themes in the Max Out Savings Show has really been assets. You want to own assets. You want to diversify. Most financial advisors are, they talk about a 60-40 split, 60% stock, 40% bonds. That's kind of what we do, but instead of just being in the S&P 500 and maybe a little in the EFA index, we really broadened it out into different other asset classes as well, more assets, more hard assets that can't be inflated away. We're really... I was listening to some stuff. It was Martin Armstrong, I think, made the comment there that basically we've moved into a period of in the 50s, it was really about owning government assets, late 40s, 50s, 60s, up to the 70s, almost to 80. It was really about owning government assets. People wanted those assets, and government bonds and things. There was high confidence in the government. There's not high confidence in governments anywhere in the world anymore, and so they're shifting more to corporate assets. This is why stocks have really gone up so much because they're outperforming government bonds. But people have less confidence when you've got $38 trillion worth of debt. How do you know you're going to get paid back? As we've been saying for, well over a year or two, we've been talking about, look, you also want to own corporate bonds, very high level corporate bonds. We almost view that as a separate asset class from corporate bonds, and we've never been big fans of junk bonds because the only thing you're going to get paid on a bond is what the interest rate you're getting. It doesn't get any better than that, but it can get a lot worse than that if the company gets in trouble, they default, something happens, and so you want to own high grade. But in a world where the government is recklessly spending money, an alternative would be very high grade corporate bonds. Now you have to understand the corporate bond market, and you really have to. We're very picky about our bonds. We really look at things differently than a lot of other people. We want to see what industry they're in, and what we really want to do is we want to understand how is this thing how are these bonds gonna perform in a very severe recession? I mean, that's kind of, or worse, how would they perform? And it might be we lose 75 or 25% of our money, but we're well ahead of everyone else that got wiped out when their stuff defaulted. And so that's really, what we want to do. We want companies that can actually go right through it, and maybe it goes down some, it will survive it. And so we really look at the assets. We try to look at the assets behind the bonds, and figure out, even if it defaults, what are we going to get out of it? With the thinking being is you want, but because in governments they'll just inflate their way out of their bonds, or they'll default on their bonds, and then you won't get anything. Or what they'll do is you'll have a 2-year bond, and then if they get in trouble, they'll go, okay, all these bonds are going to be 30-year bonds at 2% or 3% interest, and this is the way it's going to be. And so corporations can't get away with that type of stuff. So there's safety in high-level corporate bonds. This is, again, it's another aspect. Do we own government bonds? Yes. I mean, before that happens, you're going to get some warning of that well ahead of time. So there are opportunities out there in the markets. But you have to look at things differently. It's the same thing with different asset classes. When governments are just spending money around the world, and we talk about let's talk about it was 37, now it's $38 trillion, the U.S. government. I mean, look at France, at Germany. Germany has probably twice the debt ratio of the GDP of I think they have 237%. I think we're maybe 115 or 112 or something like that. Japan is in much worse shape, but at least the Japanese will keep things sorted. Look at France. France is an absolute disaster area. They've gone through 6 prime ministers in the last 18 months. I mean, it's like this all over the world. China's in trouble. They're in a deep, a very deep recession over there, probably more like the 70s where real estate blew up over there. They're struggling. They're dealing with a trade war with us. And so all around the world, governments are in trouble. Governments are recklessly spending money. Governments have no ability to cut back spending. It's actually very remarkable just how bad they are at spending and control. They've been absolutely unable to control spending. The reason why France has gone through 6 prime ministers is every single time the prime minister says, look, we can't afford this, let's try to raise the retirement age or have people work an extra 2 days a year, everybody over there goes on strike and they can't accomplish anything. Well, eventually it's going to fail. Moody's has them on, they just put them on downgrade this week. And so this is happening all over the world where countries are absolutely unable to, even in the United States. I mean, Elon Musk cut spending. I think he got to about 200 to 250 million in cuts and billion in cuts, and he pretty much walked away from it. He realized that it was going to be hard to stop, and then even the Republican Senate wants to spend more money. It's just people can't help themselves. And 50 years ago, there was governors on things. If you started spending more money, interest rates would go up, and Congress was a little afraid of that. Or you had a guy like Paul Volcker to go, look, you guys, if you keep spending money like this, the U.S. dollar is going to go to zero, and then he'd trot up to Capitol Hill, and then people were afraid to even ask a question. We've gone from that at the Federal Reserve to the Democrats have now convinced, Chairman Powell and the rest of the Federal Reserve is, look, the Federal Reserve has to be apolitical. And they go, okay, yeah, we're apolitical because we don't want you to come in. So what that means is you can never criticize our spending at all. So we can spend as much money as they want. They even actually had a theory called modern monetary theory. Since we control the world's currency, if you control the world's reserve currency, you can spend as much money as you want. And the Fed bought into that. And so the Fed never went up, and Jerome Powell never went up and criticized Congress for spending money. So these people just kept recklessly spending money. Well, guess what happened? They put in modern monetary theory, came out of where else but Harvard University. Stephanie Kelton was one of the people who wrote a book on it. We talked about it on the show. Well, now China is trying to come up with an alternative reserve currency because the Chinese and everyone else in the world, look, these Americans say that they control the world's currencies. They can spend as much money as they want. We all know where this is going to end up, and everyone nods their head and starts looking at gold. Gold has skyrocketed, been the best performing asset class this year to date. Which is remarkable. Every single time you turn on CNBC, they go on and on about AI this, AI that, Jensen Huang, NVIDIA, da-da-da-da-da. None of those stocks, the Mag 7, have come close to the performance of the precious metal stocks in gold. But, they'll talk about gold for 5 minutes. And actually, I think I timed it one time. It was about basically 90 seconds, and then they quickly reverted back to Jensen Huang and AI. But that's a big thing. This is a huge seismic shift. People around the rest of the world, they're looking for assets. They're looking for things. Hey, if I own McDonald's, at least I know what McDonald's has got. They've got these stores, and they can't just recklessly, destroy the company. Or they can't keep printing McDonald's stores. They have to build them, and they're a little prudent, and they can't recklessly issue shares. They could, but they seem prudent. Unlike the United States, it just prints more money. Our money supply is continuing to go up. The Fed's balance sheet is continuing to go up because the rest of the world is not buying treasuries. Because they're seeing sort of what's happening in the world. The seminal change date was October of 2022 during the Russia-Ukraine war, where we confiscated Russia's asset treasuries at the Federal Reserve. We didn't confiscate them, but we froze them. And at that point in time, every country in the world, including our allies, had to start looking at an alternative to the dollar and U.S. treasuries. Hence, we have $4,000 gold. And I mean, at the time, we said it was a massive mistake. We said it was foolish. We said it was going to lead to this. And sure enough, here we are today. So the question is, where do we go today? And I think we live in a world where you want to continue to diversify your assets against a lot of potential outcomes. So the question is, are we, Russia, I've said on the show, I'm surprised. I think, I'm really surprised the Russia war has gone on like this. I think we were on top of it. We let you know what was happening. We let you know the inflation implications. Within a week or two of the war, we were laying out the case in the Max Out Savings Report of the different commodities that were being produced in the Ukraine, Russia, even Belarus, laying out the case. High numbers for wheat, oats in particular, aluminum, all types of things, pointing out it's going to be inflationary. But we've done a good, but I'm surprised no deal has come from Putin either. We want something from Putin, and I don't really think it's for the dumb boss. I think it's something else, and I think we're looking at a much grander plan that Trump is trying to pull off. But could it go badly? NATO comes into war with Russia? Yeah, possibly. Could China invade Taiwan? Yeah. Talk to our military. They think that's the number one thing. We're seeing what's happening. What's going on in Venezuela? Clearly, we've reinstated the Monroe Doctrine, which is a smart move. We can't be at war with Russia or China and then have Venezuela stirring up trouble, letting Russian or Chinese troops in there to sabotage the United States. Well, then we got to put down 5,000 or 10,000 troops to go down there right when we don't have them. So that's why they're taking out Venezuela right now. They can't allow this to happen. They're preparing the thing. So there's a lot of different. What's going to happen with this out of control spending? What's going to happen with France? Are they going to be on their 20th prime minister? Will they collapse? No, there's just so many. What's going to happen with AI? I just saw some numbers that Oracle's balance sheet is spending wildly out of control. They're building so many AI things to the point that the debt might be so big it could take down institutions out there. Is the economy slowing down? What's going on in the subprime auto market, which appears to be collapsing? Why is spending dropping out there in restaurants? The worst 2 months since 2020. What's going on? All these big things are happening, and there's a lot of all potential possibilities. And in that world, what you want to do is you want to space out your retirement assets, protect them, and increase your cash levels. And we'll talk more about that right after this quick break right here on the Max Out Savings Show.
We return now to the Max Out Savings and Investment questions. Ted Gioka has answers. Call the Max Out Savings Show now at 713-339-1070. We'll be right back.
Hi, this is Ted Gioka of the Max Out Savings Show. Our motto and philosophy is to save aggressively and invest conservatively. The world is changing at a faster rate than any time in the last 50 years. The investment world has changed. Have you changed? Inflation will destroy your retirement. It is a different world that requires different strategies and ideas. The era of indexing and investing is over. If you need help, listen to the Max Out Savings Show. Our show airs every Saturday at 10 a.m. and Sunday. We talk about investments, the world, and where the world is going today, and help you understand it and help you save money and build up wealth. It's the Max Out Savings Show. And if you need some help, go to our website, maxoutsavings.com. That's maxoutsavings.com. On the website, you can sign up for the free Max Out Savings Report. Our report covers all types of these big issues, the changes in the world, and helps you understand and protect your retirement. So go to the website, maxoutsavings.com.
Hi, I'm Sam Malone, the owner of Houston's cutting-edge media company called 512 New Media. At 512 New Media, we create amazing videos that companies use on their websites, telling their story in bold colors with exciting animation and graphics. At 512 New Media, we also shoot television commercials and instructional videos. And if you want to show off your business from the air, we're ready to go with our drone video aircraft. Let us help you create your media message. We're online at 512newmedia.com or call 281-822-8803. 512 New Media is Houston's only media creation and distribution company that's actually owned by someone who's currently on the air. And that gives us an incredible edge when creating content for consumers to use on their laptops, tablets, and smartphones. Standing by to create your message, we're 512 New Media. 512 New Media.
We return now to the Max Out Savings Show. Here's Ted Gioka.
Welcome back to the Max Out Savings Show. I'm Ted Gioka. We're talking savings investments in your retirement. Yeah, if we were just talking about really the movements happening in the world today and the importance of that, again, that diversifying across different asset classes, holding additional amounts of cash. Even money markets still yield, 3.75% or something. You can get very good rates on other types, 2-year bonds. You can lock into. So we see way too many people out there just 100% invested all the time, and then when things change, you don't have the ability to come in. You don't have the ability to come in and take advantage of it because they're fully invested all the time. Money is made. You can make money very quickly when there's problems, but you have to have the cash available to do it. And this is one of the things that I think that is just really not well understood out there. And so something I think it's increasingly important to talk about and to understand. What's going on. The other fascinating thing we're seeing out there's enormous amount of talk about bubbles. It's just all over the place, and it's just running through. Looking at the Barron's this week newspaper, a couple things. Are you afraid of the AI bubble? How to protect yourself? The AI bubble won't just take down stocks; it will slam the economy too. How to keep the market sky high, or what can keep the market high or knock it off its perch? different things, because there's a lot of talk. I mean, the trick with any bubble is to figure out when it happens. And sometimes the better what we found is once it reaches stages of where it just starts getting stupid, you're almost better off looking in other areas, trying to go, see what's a better value, what can I do? What's a reasonable thing that nobody else is watching and just get out of it. And then because that tends to be about about the best way to do things over time. I think we really have an extraordinary record when it comes to dealing with crisis. Yeah, and looking back on it, what we really found is just being in kind of the next thing sort of thing that no one's paying attention to seems to be the best way to diversify and protect yourself. One of the more interesting ones out there is really the oil and gas sector. If you look at some of that, it just seems like there's if you look at oil, it really traded up. It had a huge jump up in '74 to $10 from about $4, but then it really traded from about between 10 and it did some at 40, but it traded around $20 from really 1973 over almost up to 2000 for about 20 years almost. Actually, more than that. And it was about 26, 27 years. And then it moved up again starting in 2004. And so we've had another where it really went from 40 trading range, with the really exception of the shutdown of the pandemic, up to about 95, 100. So 40 to 100 range. And here we are. This is about, if you look at this, we're about 20 years into this move. And so at $60 oil, it just seems like it's hard. A lot of companies are cutting back on oil production. And there's huge demand for energy around the world because of AI. And one of the quickest ways to generate energy is to electricity is for natural gas powered generation. And so I think natural gas is a real interesting play in here. If you look at the price of natural gas, it's about $3 something, and which is just remarkable. I can remember back when in the 90s, when on a good year you might see $6 or $8 gas, and here we are at this level, which is. Let me see. Which is just incredible to me that the pricing is at this level. It's just, the $3 level. You really have to go back 30, 40 years, and you put any type of inflation number on that. I mean, it's the same thing with the oil. If you put any type of inflation numbers on these oil prices, they're ridiculously cheap. And so the energy sector is one area that pays reasonably good dividends and will give you good returns. And so there'll be other things out there, but again, it all comes about this diversification across different asset classes. We try to get different thematics. One of them is, of course, the precious metals has just done incredibly well for us. We looked at the natural gas, in particular oil sector. That's another one. We're looking at some growth stocks in retail. We're looking at other assets in timber and things like that, where again we're looking where these things throw off income, which will fund retirement, but at the same time will grow over time because they own the land, they own the forest, and so if you can just pick up, 4.7% in basically what is a very long-term asset, a 100-year asset, which is even better than many of the MLPs out there, because many of those guys have a lot more debt, and those pipelines do eventually have a lifespan on them, or the field goes dry. And so those are the type of things that you want to deal with. And the question that's going to happen is, can President Trump move the economy? Can he rebuild it and get the factories back to the United States? And I think that's a reasonably good bet. It's really remarkable how, look, if Trump fails at this, if the factories don't come back to the U.S., if the economy goes down, and we don't get the factories and we don't get the growth, look, there's no way we can fund up the $38 trillion worth of debt. They're just going to inflate their way out of it, or you're going to have a deflationary depression. It's one of the two. And what's remarkable is you have half of the political establishment are rooting for that. They're like, look, hey, Donald Trump is so bad, I'm willing to look. We go back to the Great Depression with food lines, it's worth it to get rid of Donald Trump. Now they're not saying that, but that's the only alternative. If their plan of raising taxes on everybody isn't going to get them where you need to be, and so his plan, as we've talked about in the show endlessly, he has a very solid plan. Put tariffs in place, collect $200 or $300 billion. With the tariffs in place, also negotiate some of them down. If U.S. companies or multinationals bring their factories back to the United States of America. Number three, cut government spending through the Doge Commission and other programs. And number four, have the Federal Reserve cut interest rates. That is a doable program, but which will work. That's into next year. Right now, things are slowing down. Illegal aliens aren't buying automobiles. They're not buying houses. They're not going out to restaurants. And people forget there's probably 25 million illegal aliens if there's one in this country. They're all worried. How would you like it if you're like, hey, do we go out tonight to a restaurant or something? You're thinking, well, what if we get picked up? Maybe no. Let's just lay low until things calm down. I'm just going to go to work, or I'm going to go to the grocery store. We've been talking about this on the show here for over a month, month or two, and I haven't heard anybody else talk about it anywhere out there. But that's the facts. No one wants to really bring that up. Is these people are afraid to spend money right now, so that's causing a slowing of the economy. Look at the subprime auto market is just imploding. Huge numbers of cars are being repossessed. That's because people aren't going out to work, or they're afraid to work, so they're just giving back the car. So we have this period in here where things are slowing down, which normally you would see a big sell-off. Keep in mind, I think it's been like 51 months, one of the longest time in history where the PMI number's been under 50, which means we're not really growing the economy very much. And this is really, if it wouldn't be for AI, we would be in a recession right now. Now, the AI is booming, but it'll be the AI plus the factories coming in next year, which should be very good for the economy. Now, we'll just have to kind of see what happens, but those are some of the things out there. So, again, I've thrown a lot of stuff at you on the show today, but what don't you understand is, look, it is a very complex world. There's an enormous number of moving parts. There's enormous numbers of parts that are old, decrepit, that could break down and the whole thing blow up. And the question is, what's going to happen and how? In that environment, you really have to spread your risk out to understand from multiple outcomes. Now, a couple other things I wanted to touch base on is with retirement. As we talk, there's a lot of talk about retirement. When it comes to retirement, what most people do is they look at their money. They said, "Oh no, I need to do something with my money." So they get a manager to manage it. They start budgeting ahead of time, and then maybe they decide where they're going to retire. But it's actually much more in depth on that, and we're going to try to be covering more on this on the show in the future here. But really, it comes to a couple things. Do you have enough money for retirement? You talk to someone, sit down, find out the numbers. Numbers used to be about 4.3%. They're really talking like the number could be closer to 5% you could take out right now a year. So a quick number is, if you've got $1 million in your retirement, you can take out $50,000 a year, plus your Social Security, plus everything else. How are you going to manage it? As we've talked about on the show, the research is starting to show, which is a real surprise to people, is that if you take a big hit early on to retirement, it's much more damaging than if you hit later on. A lot of people think, oh no, if I'm 90 years old and my account goes down 50%, I'm really in trouble. That's really, because really, candidly, you probably only got 5 or 6 more years with it, and so it kind of is what it is. But if you're looking at the damage being done, it's in your 28th year, your second year retirement, you got another 28 years left. That's super damaging, and it's really not well understood, and that's why you want to have that diversified, broad-based account, and not counting on a skyrocketing stock market to keep your income going for 30 years. And so, in budgeting your funds, as you approach retirement, that's when you want to start cutting back your expenses and to see if you can do it. It's very difficult to cut back expenses. As everybody knows, I mean, it's easy to spend money. One of the most remarkable things anyone knows is, as they're going through their work life, they'll go, well, if I can just make, back in the day, it was like $25,000 a year, I'll be able to have plenty of money. And then it was, if I can just get hit $50,000, that'll be, and then if I can get $100,000, I'll be able to spend what, and each time your spending goes right up to that level and you're in the same spot, you typically. And so you have to work on budgeting, money management, budgeting, and understand that you want to grow your money over the long term. Do you realize that it's close to 98%, 98% of Warren Buffett's wealth was created after the age of 65. Think about that. Now, part of that is inflation, but to be fair, Warren Buffett wasn't living off of his money and stuff, and so, but understand, and I've seen this happen numerous times with people, there's enormous amounts of wealth you can build up after retirement, and this is why you want to manage your funds and not spend as much as possible, but build it up over the long term, because with the power of compounding, you can build up a lot of money between 65 and 95. A lot of people think, well, that's it. This is all I've done, and they kind of check out. But that's really, there's still opportunities. I mean, you can actually invest longer term at retirement, I believe, than you can before retirement. Because the reason is because you can actually have the ability to think much at the, when you get your 60s, you're able to think much longer term, contrary to what most people would think, than shorter term, because as you're growing up, you go, oh, if I can just get a house, we'll get a house in 2 years, and then you have kids, and then when maybe by the time they're 10 years old, you go, oh, no, I need to start saving money. It's typically the way it works for a lot of people, and so they almost think in. Whereas with retirement, you have to think in 10, 20, 30-year time frames, and so you can continue to grow that money down there. So you want to have that in mind, and you can lay in some investments for long term, or hey, I'll do this. You can, buy a piece of property or something, figure I'm just going to sit on it or have it paid off in 20 years. It can't be that big, because you got to use what you got to fund it, which is a little tougher sometimes. But then in my 20th year of retirement, I'll sell it and boost up my income. Then there's all types of different ways to do that. We can help you if you ever have any questions on that. The question is, where do you live? This is what are you going to do? Are you going to stay in Houston? Are you going to go to the Hill Country? Are you going to go to? Are you going to go over to? Wherever you want to live. 20 years ago in Houston, we've been managing money for well over 25 years. 20 years ago, nobody ever left Houston, Texas. Didn't happen. If they did, they'd go to North Carolina, they'd go to Arkansas, the Hill Country. The majority of them would come back to Houston because they loved Houston. Now, a lot of people are moving out, and my sense is they're not coming back. The crime has gotten out of control. The traffic is horrific. We've become more like a blue city. I can't even believe I'm saying that. And so where are you going to go? You have to make that decision. Yeah. Or if you're going to stay at your house, are you fixing it up? Keep in mind, if you're going to live in your house for another 25 years, you want to get it fixed up now so it'll go that extra 25 years. You really don't want to be in the house for another 10 years, and when money's much tighter further into your retirement, trying to figure out whether you want to fix it up. You're almost better off fixing it up ahead of time when you got the energy, you got a little money, and it's all fixed up, and you're ready for retirement. And a lot of people don't really look into these. You really want to think things through for retirement, and kind of. It's not just, where am I going to live and how much money do I have, but you want to kind of dig in a little bit. Is the house good enough for me? Do I want to be in a one-story house so eventually I can just live downstairs or whatever? We get a lot of stuff like that. Where do you want to be? So think things out. Now, tell you what, we're going to be right back, kind of expand upon this right after this break right here on the Max Out Savings Show.
The Max Out Savings Show with Ted Gioka will return shortly. To speak with Ted Gioka now, call 713-339-1070. Back in a moment with the Max Out Savings Show.
I'm Sam Malone, president of 512 New Media. We're Houston's leading marketing and content creation firm for many reasons. Our assets are exceptional, from video production to web design, strategy, and the ability to say no. Saying no is integral in launching a successful, profitable campaign. For example, take a look at Memorial Day. It's a federal holiday set aside to honor and mourn those in our U.S. military who died while serving our country. I'll say it again, for those who died while serving our country. Look, we know people will be at the beach and barbecuing and having parties. We would probably say no to launching a Memorial Day sale. So is there another way to commemorate the day while marketing your brand? Absolutely. And from our experience, the same holds true with Easter Day sales and MLK Day sales and Christmas Day sales. That's why we're different. No cookie cutter, follow the crowd, template marketing. Let's talk. We're 512 New Media. 512 New Media. With better marketing comes better value, creating better results.
I'm Ted Gioka, and I approve this message.
Inflation, instability in the market, bonds, precious metals, oil and gas, and lack of old-fashioned cash puts your retirement at risk. It takes a different type of portfolio to deal with these issues, and that's where Ted Gioka can come in, and he can help. Go to MaxOutSavings.com and schedule some time with Ted. That's MaxOutSavings.com. And listen to the Max Out Savings Show every Saturday at 10 a.m. on AM 1070 and FM 103.3. The Answer.
And now, more of the Max Out Savings Show with Ted Gioka.
Welcome back to the Max Out Savings Show. We're just talking about some of the changes at retirement, how you want to kind of dig in and you want to plan it out a little bit. We're just talking about Warren Buffett. Warren Buffett went from, I think at 65, he had $3 billion. He had $151 billion by the time he was 91. So, that's, now keep in mind, that's 36 years. But again, this goes back to what we've talked about overall. That's 26 years, excuse me. But really, retirement is a long-term game, and you really want to understand that. I mean, most people don't work 26 years before they retire. A lot of people do, and so it's a long-term game. And okay, another thing, healthcare. You're going to spend about $300. The typical person couple spends over $300 for healthcare. And again, are you near good hospitals that are going to get high quality health care? I mean, one thing about Houston, we've got the best health care in the world. It seems like I remember over the years, I know people that would get cancer, and it seems like they didn't make it if they were elsewhere in the country, but it seems like people always many times recovered in Houston because we had much better health care. A lot of people are going out to different places. They're going to the Hill Country. They're going to New Mexico, Arkansas, the Carolinas. Is there health care nearby? In some places, I know, you got to get, if it's a serious thing, they almost have to put you on a medevac to a big city. And so you have to think these things through. If you get sick, you're going to have to be going back forth to the doctor. You're going to have to be driving an hour and a half, 2 hours, or more to go to the hospital, back and forth. Some of these things need to be sort of considered. And this is why a lot of people sometimes move back to Houston, is because it's for the health care. And when it comes to health care, it kind of merges into the other thing is health care is one of your biggest expenses at retirement. Well, if you can stay healthy, it's pretty simple. You're going to spend less on health care costs. And now, look, there's not a lot you can do, but one thing that's real clear is there's two things that'll make a big difference to your lifestyle and to your health care. One of them is eat correctly and eat healthy. I try to eat healthy, not always, but I try to avoid, everything from, the seed oils to that's a real big one. I use a lot of olive oil for everything. I even try to avoid corn sweeteners, and I try to reduce the sugar. I seem to fail on that, but I try to really control what I'm eating, take supplements, those type of things, make yourself healthier. Even though I'm still working now that I think about it, but you want to control what you eat. The other thing is exercising. Those things are rock solid things. They have these blue zones around the world. Inevitably, it comes down to the food and the exercise. I remember I was in Greece years ago, and I was in this town up in the mountains, and we're talking something. And some lady walks by, a little old lady walks by, and I made some comment. He goes, "Yeah, these old ladies, everyone else drives around town. These little old ladies, they walk back and forth all over town, up and down. They live forever." It was, that was the comment at the time. And the research is real concrete about simply walking a mile or two 3 or 4 times a week around the neighborhood increases your health. And these are real simple things. Eating well doesn't cost a lot, typically much more, and exercise. Walking doesn't. You can buy some dumbbells and do some stuff around the house, or you can spend a bunch of money at a club. Either way, you can get probably about the same results. But come up with a plan. These are simple. They cost nothing. Virtually nothing for that. Even the higher quality food, typically for what it costs extra on things like olive oil, you save by not buying the junk food, which seems like it's somehow more expensive anyway. And pay attention to the stuff on the products of what you're eating. And so, but that does two things. It helps with your health care. Okay, which is going to save you money, and it's going to your lifestyle is going to be better. You're going to be happier. You're going to be feel weller. These are very simple things that to do. I mean, walk a mile 3 times a week is it's kind of a minimal thing, but that makes a big difference. And so do that. The other one is to what are you going to do when you retire? I mean, this is a question that a lot of people need to ask. I think women have it a little easier because they'll be working around the house and stuff, whereas and they can. Men, it's tougher just sitting around doing nothing. We find at least, and they have to be trying to do something. And I think for men and women, if volunteering, and there's all types of things. We were up there at the hospital here last week, did some stuff for my mom, and you walk in the door, and they had volunteers telling us where to go. There's all types of volunteer organizations that need people, and it keeps your mind sharp. Working with people, you enjoy doing it, but have some type of plan. My dad, I think he worked to 90. My father-in-law, he was pretty much working into his 90s. He did huge amounts of volunteer work into his 90s, and really it made a difference. So understand, you have to come if you're going to retire. What are you going to do? In golfing, it's not. I mean, look, golfing helps. Don't get me wrong, but you have to have other things as well. I think the volunteering is possibly even better than. If you had to say, Ted, can I be golfing? Would this count as exercise? Or I would say volunteering is going to be a better purpose, and I think you'll live longer. Nothing against golfing. I wish I had the time to do it, but I don't. I'm here every Saturday, and those. But so the key to retirement is have a plan. But it's not just have a plan for your money, but have a plan for your life. But it's a simple plan. But if you look at people that live into their 90s, they tend to be pretty simple. They tend to kind of do a little exercise, even if it's just walking around or staying active all the time. They tend to stay engaged with people. They tend to be, and even if they're kind of stuck at home, they tend to be engaged. And you want to those. They tend to eat well. I mean, it's almost all they tend to attend church services, religious services. Those things they live a simple, very full life. And so, what is your plan going to be to have a simple and a full life at retirement? And this is something that just really is not talked about. I think the worst thing is if you just retire and don't have anything to do. I think it's so important to have a purpose in life. And maybe it's taking care of the grandkids, which is a huge, but that's a purpose. And that's actually a real valuable purpose. But it's the little things. It's not, you don't have to volunteer at a high level or, be an executive coach or whatever. It's simple things. If you look at the simpler people make it, the better off they do. In retirement, simplicity is one of the real key things to it. It just that's what I notice. I see these people, and we've dealt with them for years, and it's kind of always they just very simple life. They say very active, they eat well, and so when it comes to retirement, have that plan, and set up wills, your estate, make sure that's taken care of. If you want to give some donations or something, and you put it in your will. Try to make it something that people. This is the one thing I will say about that. A couple thoughts when it comes to giving. My philosophy is try to give to someone that actually needs it. I won't use any names here, but there's some people out there that they have enormous funds already, and there's other groups that really need the money. The other thing is when you retire, and this is when you get a windfall, an inheritance, hit the lottery, or whatever. When it comes to giving, have a plan, set your plan up, and watch it, and have a budget for giving. So my budget for this year, I was talking to someone the other day. He gave 10% every year. 10%. Matter of fact, when he got his retirement rollover, he actually gave 10% of that to the church, which just shows you the level of his commitment. And so, if maybe you decide to give $10,000 a year to giving, well, put your $10,000, allocate who you're going to give it to. Leave maybe $2,000 blank so you can kind of hit your budget. And this is what very wealthy, sophisticated people do. So once they hit their budget, people call up and because people are always wanting money for them more. And so if those very wealthy people have a little better ways to deal with this, is they go, look, I've hit my budget for the year. Talk to us next year. This is the best I can do, or I can give a token amount, and that's it. So when it comes to giving, set that budget up, and don't get pulled off of it, and then try to find people that need the money where it makes a difference. Where you can really help, and you can look back one day and said, a friend of mine started up a big Christian organization. They started out, I gave them, it wasn't a huge amount of money at first, but it really meant a lot to them because they didn't really have, now their budget's probably $1 million plus a year. At the time, my money made a big difference, and you can do the same thing. So some of the thoughts there, That's just what the giving. A couple thoughts in the market. Precious metals are in a correction. Look, we pulled some money off the table in here. Just really more managing rebalancing, we're not super tight on the rebalancing, but it's just, we've done so well, we had to do something. It's hard to tell if I had to guess, I'd say maybe gold breaks 34,000, maybe goes down to 3750. I think one of the things to watch with the precious metals, watch what gold does with this Xi and Trump meeting coming up. I think that's going to be a real tell. I do think they're serious about building an alternative to the dollar, and gold is going to be part of it. The Indians want silver in as part. I still think over the longer term, I think silver goes to 60 to 90 range. Those are some of the things that we're kind of seeing. But again, manage your risk. Always manage your risk on that, and nothing goes straight up, and you can never be sure of anything. And just as we talk about, this has been a big move up in the market, so manage the risk. I would be feeling better with more cash up here. And look, if it goes up, hey, you're even happier, make more money. You don't want to sell everything, but just you have to make that decision. A couple other thoughts. We're going to put out our Max Out Savings Report, which comes out once a month. That's going to be coming out soon. It's a completely free report we send out. We've been writing this report for over 20 years now. In 2007, we wrote, probably October of 2007, I think we wrote about how the investment banks were going to fail in 2000. Well, we didn't say 2000. We said they were going to fail, and investment bank was going to fail. The only thing we were wrong on, we thought it was be Lehman Brothers first. It was Bear Stearns. But the difference between us and most people is we don't just say there's a bubble. We try to make the case. We said, look, we laid out the balance sheets of Bear Stearns, Lehman Brothers, and we said these things have grown 35% in the last 9 months. The collateral underneath is starting to crumble, and they were going to have a run on the balance sheets, which is exactly what happened. We write about these things in the report. In 2020, January, we said, COVID's going to be a problem. Maybe it was February. For everyone else was saying it's nothing. We said, no, this is a serious thing. We try to bring big, fast-changing ideas to you quickly and to keep you ahead of everyone else to protect your retirement. So if you need some help, go to the website, maxoutsavings.com. It's maxoutsavings.com. And you can also request an appointment. I'll sit down with you and show you how we manage funds using our value investing approach to the stock and bond markets to manage your retirement. You can just go in there, get our phone number, give us a call, or email us, and we'll set up an appointment here in Houston, Texas. So if you need some help, go to our website, maxoutsavings.com. And remember our motto and philosophy, which is to save aggressively and invest conservatively. That, my friends, is the key to building up wealth over the long term. I hope everyone has a great weekend. We'll see you next week right here on the Max Out Savings Show.